Hello, fellow investors. Before we continue on my video on investing, just a reminder that the information in my videos in no way constitutes financial advice. The information presented is for educational purposes only. On this video, I will primarily focus on the basics of how to invest in stocks. How to get started. First, you will have to open a brokerage account. I actually recently helped my wife's friend, and it's actually very easy. Whether you're looking to open an account with Fidelity, Charles Schwab, E-Trade, or any other platform that is of your choosing. Here is just an example of the Fidelity website page. As you can see there, I have boxed the Open an Account button. So it's as simple as that, going to the website and just opening an account. Next, you will want to fund your account. Basically, you will attach your bank account in order to then transfer funds into your brokerage account. Conversely, you can then also, once your investments are making money, or if you would like to pull some of that money out, that is also the mechanism to move money from your brokerage account into your bank account. You will then also have the ability to use the research tools, where you could look up stocks, information about company's business, stock history, other metrics, financials, and other investment data. Here is just an example of the Charles Schwab screen where I pulled up Microsoft. As you can see, I've circled there. I've also circled that for the year, for year to date, Microsoft is up about 24%, which is exceptional results. As you can see there, Schwab also provides you their own rating. There's other company information. There's the 52-week range of how the stock has performed, different charts. And if you did scroll down, you would see a number of other information that you can access as well. Next, you would then select a stock. And actually, it's not that simple. This is probably the most difficult step in the process. After you selected a stock, then you would simply click on Buy. And it's as easy as that. I'm actually just kidding. How do I determine which stocks to buy? For me, I read a lot of articles on different investments, different companies, whether they be speculative or they may be very mature companies. You will always see, once you do a little research, you'll see many varying opinions by the analysts. And sometimes it's difficult to get a read and to really understand, especially when they're conflicting. That's why I believe that ETFs or mutual funds are a great option, especially when you are starting. The other point to also consider, and I have briefly mentioned this in a prior video, is look for things that are familiar to you, everyday things especially. Simple examples: food, clothes, utilities, cell phone, to name some there, shopping, search engine. All of these are things that we do in our regular daily lives. And based upon these things that we do, I know that you can name specific companies that pertain to each of these particular areas, whether it be Google or Amazon or Costco or Verizon or AT&T, any one of those, Facebook, just to name a few. Want to name Warren Buffett. I'm assuming that everyone has heard of Warren Buffett. I had read an article some time ago, and what he had mentioned was that index funds provide a very good diversification for your investments. So that's something that in that particular article that he had mentioned. Interesting enough, I just read an article that named Warren Buffett, and he said something a little bit different than the diversification for index funds. And what he then said in this particular article is that you don't want to be over diversified, as this can possibly weaken returns, that you should look to concentrate on businesses that you understand. It went on to basically say that if you're not familiar with investing and investing in specific sectors or industries, then for that type of investor, a diversified fund would probably make very good sense. How do I know when to buy and when to sell? That is a good question. The simple answer is you will never know when the perfect time is to buy and when the perfect time is to sell. This is what we call the crystal ball. No one has a crystal ball, which essentially we all hope as investors that will tell us when is the perfect time to buy and when is the perfect time to sell. No one has that crystal ball. So that's why what you need to consider is the effect of time, as I have mentioned many times. The more time you have, the better chances you have of your investment working to the way the investment was intended, which is to provide you benefit during that investment cycle. What do I need to keep in mind as I am investing? There are two key important points to keep in mind when investing. The first point is the buy point, the point that you buy your investment. The second point is when you actually sell that investment. That would be the second point. So those are the points in reality as to what you need to keep in mind that will, in effect, result in a realized gain. Anything that happens in between those points and during this period of time is really irrelevant. So again, investing is a time game, a time situation that you have to keep in mind those two important points and try to let the emotional roller coaster during that period of time in between those points to try to keep your emotions in check and just stay focused on the end result. The other point to make is in regards to time regarding your investment horizon. So some people look at investing in stocks in a short term where they're trying to turn a quick buck, make a few dollars, cash out. What I'm primarily focusing on is the long-term objective, which is to invest for retirement purposes, where you can truly allow compounding to its maximum benefit, to gain the most benefit from compounding over time. Just want to touch on compounding once again. I know I had mentioned this and I had mentioned this specific example. Let me go over it very quickly. If you invested $100 at a 10% per year return, so after year one, your balance would be $110, which would be $100 of your initial investment plus 10% of that $100, which is $10. So at the start of year two, you would start with $110, again, assuming that it earns 10%. Then after year 2, your balance would be $121, which would be your $110 plus 10% of your $110. I actually read a recent article that basically said if you invest $100 per month over a 40-year period, that would be worth $1 million after 40 years. Let that sink in for a moment. Sounds doable, right? So what the article didn't explain is, well, what kind of return are you looking at in order to get to the $1 million? So I ran that through my calculation. And essentially what it would take is a average return of about 12.5% in order for that to reach the $1 million. Now, that might be doable, but if you, just to give it context, I ran it through a 10% annual return, and that yielded over $500,000. Still, very good return, even at a 10% return. So this information is, and it's probably a little bit difficult to see, but this is showing the entire history of the returns of the S&P 500, which is a broad index that basically shows the returns by year for the broad market of the S&P 500. All of the blue columns are gains. The red columns are the years where the returns were negative. As you can tell just visually, there are far more blue columns or gain years versus negative columns or loss years. The average return of the S&P 500 since inception, which was in the 1920s, it averages somewhere between 10 and 11%. So I believe that's where most of the indicators, as far as if you're looking to see on average how you could do invested on a very average basis, 10 to 11% is sort of the gauge that is used. Okay, so in closing, as I've mentioned many times as well, let's continue on this path. Let's achieve financial freedom so it gives us a fulfilling and enjoyable life. Thank you all once again for your viewership. If you could like, share, and or subscribe, that would be greatly appreciated. So let's move this forward and look forward to seeing you on my next video.